Welcome, ladies and gentlemen, to the Cima SCS E3 Essentials Revision segment number 1. So in this segment, we will be taking a look at ecosystem, strategy itself, and within the ecosystem, the idea of strategic networks and how important networking is when it comes to organizational strategy and how it links to the ecosystem as well. Let's have a look. But before I dive into the content, I want to give you some instructions about what you must do. Please have a notebook and pen on the ready. Follow the slides and my explanations very carefully. Make notes as you deem them necessary. Do maintain a list of key topics that you feel you're weak at so you can self-revise later, and maintain a list of key performance and management tools that can help modeling answers in the strategic case study. Right, so make sure in E3 there are so many strategic management or performance management tools that are getting discussed. So make sure that you maintain a list of them that will help you later when you in fact model your answers when you're writing for the case study, especially when you attempt your mocks. On that note, let's start with the content. Obviously, the fundamental question, what organizational strategy is. So what is strategy? Cima defines strategy to be a course of action including the specification of resources required to achieve a specific objective. So it's not exactly the answer to what, right? Organizational strategy or strategy itself means more how, what is the route or how are you going to achieve something rather than what are you going to achieve, right? That is in most simple form what strategy means. So a simple example is that if you want to get from place A to place B, right? Let's say you want to go from India to Australia. You might have multiple ways to execute this, right? Maybe 2 ways, maybe 3 ways. Now those are your strategic choices, right? So, or rather, the options that are available for you to execute. Now, the one that you choose, how you are going to execute this journey from place A to place B is essentially what strategy means. It's a course of action you undertake. Corporate strategy can be complicated because there are multiple levels, layers, functions and types are involved. There are operational level, strategic level, tactical level, that layering of the corporate hierarchy itself. Then you have all the functions and all the departments and all the divisions of the company. This can make strategy formulation even more complicated. And the most commonly discussed model of strategy formulation is the rational planning model, among others such as emergent, incremental and freewheeling approaches. So if you really think about the E3 syllabus, most of the things that are discussed are titled, or the titles of those are extracted from the rational planning model because it is quite, as the word suggests, rational. Now, within the process of strategy formulation, you have to have a basic understanding of these elements. So obviously the levels of strategy, corporate, business and functional. You have the different models, rational, emergent, incrementalism and freewheeling. Among those, rational is our primary focus. We have the approaches to strategy formulation. It could be accounting led, market led or competence based, which essentially are self-explanatory here, because if you let your numbers drive your strategy, then you're accounting led. If you let your market lead your strategy or the consumer, it's market led. And if you look inward and if you identify your competences, your strengths, and you let that be the deciding factor in formulating strategy, it's competence based. Then strategic management accountant himself, or who we generally refer to as a chartered management accountant, is supposed to be a good strategic management accountant. Therefore, in addition to the traditional responsibilities that a management accountant used to bear, there is this additional external focus and being forward looking. These are 2 elements that have come into play in the management accountant's current role. This is why, for example, Burns and Scappens proposed that the modern management accountant plays more of a hybrid role or a hybrid accountant's role rather than single focus on things like cost accounting and budgeting. Then we have to understand, of course, what organizational ecosystem means, and ideally these things would entail the overall process of strategy formulation. And in the following slides we will be taking a closer look at everything that relates to strategic formulation and ecosystem. So as I mentioned, the rational planning model is the fundamental framework that we will learn various things through, and it is quite rational. Even if you were to start a business, this is obviously the model that you would ideally follow, where you might have a vision, but in order to realize that vision, you establish mission and objectives. Then you identify your position and you appraise your environment, which basically involves two parts: the internal environment and the external environment analysis. Then you move to strategic options. From the options, you evaluate and choose whichever option is the best fit for you, or what you deem as to be the best fit for you. You implement them, and you review and continuously try and exert some control to ensure that your implementations are in line with your plans. And as far as this is concerned, you learn a lot here from this stage, and therefore it feeds back into internal environment analysis, external environmental analysis, improves your intelligence, which then comes back to your awareness of the space that you're operating, so you can improve or you can evaluate further and identify better options. So this is really just a creation of a loop of a never-ending cycle, and that is the basic snapshot of the rational planning model. On that note, let's take a look at the stages of the strategic planning or the rational strategic planning model. Johnson, Scholes and Whittington took the stages from the rational model and grouped them into three main stages. The first one is obviously strategic analysis, which involves external analysis, internal analysis, stakeholder analysis, and even gap analysis. The second one is strategic choice. How to close these gaps. You identified how are you hoping to compete, which is essentially your competitive strategy. How are you expecting to grow? What are your growth aspirations? And how are you in the long run planning or expecting to divest and diversify and just expand the horizons of your business, not staying in one line, but maybe expanding into other lines of business as well. And that is strategic choice. And finally, the implementation itself. Once you choose, you need to come up with a plan of execution, budget for that. You need to set targets, and you need to set up a mechanism where monitoring and controlling is ongoing. These are the three stages of the JSW proposition of how the rational planning model was grouped: strategic analysis, strategic choice, and strategy implementation. That brings us to the idea of organizational ecosystem. An organization's ecosystem is made up of a network of organizations, including customers, suppliers, distributors, competitors, government agencies, etc. So basically various groups of stakeholders. They involved in the delivery of a product or service. This can be through either cooperation or competition. So when you try and gauge or when you think about this definition, it's pretty much just the environment you operate in. And every group of stakeholder, every company that is part of your operations, that is part of your environment, all those elements are part of your ecosystem. They could be directly associated to you, they could be indirectly associated to you. Either way, they are definitely part of your ecosystem. And the idea is that all components of an ecosystem impact on each other, creating a relationship that is constantly evolving and within which each organization must be flexible and adaptable to survive. Right? As I mentioned, every component of an ecosystem will impact each other. Right? We live in a day and age with highly connected, capitalistic, globalized notions that if you burn a forest in the Amazonian space, it can affect the world largely, right, in terms of global warming. If you basically increase the oil price, right, if oil demand is less from the OPEC regions, it means that it will affect almost all nations in the world in terms of the cost that they bear to fuel their industry and their industrial capabilities. So it's that connected. So an oil well somewhere in the south of Atlantica can be a part of your ecosystem if it has the power to affect your business. That is the connective nature of the ecosystem that we live in today's day and age, in modern day and age. This is why you will notice that E3 discusses a lot, and E3 has actually brought in a lot of digital elements, because it's that digital capability that connects us all. If there was no digital capability, this connectivity would be far less, right? So understand that ecosystem can be a very vast idea with so many elements in play. And that brings me to the thriving in an ecosystem idea. So to thrive, to be successful within an ecosystem, you have to create value. And therefore, how do you, or what is this idea of value creation in ecosystems? Now, in order to create value, first an organization must understand itself. Now, this is done through internal analysis. And a resource audit can lead the organization to combine them and achieve these competences, as you would have learned, your core competences and your threshold competences, right? These are competences that on the one hand there are things only you can do, and on the other hand there are things that you must do. Like for example, you have to have a basic and reasonably good competence in terms of accounting. Any company has to have that to manage their finances, to manage their books. It is an essential element, but that is general and that is common to all companies. Other than that, what exactly is your competence that differentiates you from the other? That understanding is critical. And knowing your competences is critical to identifying the critical success factors, because you're good at your competences, but you need to be good at, or you need to be great at your critical success factors. So CSFs, critical success factors, are factors that are critically essential for your business's successes. That's why we call them critical success factors. So identifying them very early on when you're operating within an ecosystem, even identifying the competitors' critical success factors, can help you know yourself better so you can do better. Ultimately, an organization needs to create value to its stakeholders, mainly the customers. And the value creation process is made easier when you know what your value drivers are. And this is actually the idea that has, progressed or bloomed into what we currently call the value-based management concept, where you try and identify what your value drivers are. And if you know what your value drivers are, you can tune them, you can use them, you can utilize them, you can in fact drive value up using those various elements. Considering the external environment is also critical, because any organization is always a part of a massive ecosystem within the macro environment. And therefore, the value chain and value system itself can help simplify the value creation process, but ultimately value creation is also very unique to each businesses, and this uniqueness, this unique selling proposition is what will ideally make a business successful, right? Now here in this slide we looked at some keywords, right? There are internal analysis, resources audit or resource audit, critical success factors, value creation, external environmental analysis, value chain and value system. All of these are various tools and various actions that we need to undertake to understand our ecosystem better and improve our competencies and operate in the best possible manner within the market that we operate. That is where we also have to try and understand the drivers of change in an ecosystem, because we live in changing times. This is why change is important. If you remember, my fifth segment will essentially be on managing change. How do you manage change? So within an ecosystem, change is inevitable, change continuously happens, and the main drivers of change they can be institutional or systemic changes. Like for example, now as Donald Trump came into the system of managing the US White House or the US federal arm, there were so many institutional and systemic changes, or rather going back on some major changes, especially his predecessor had included. They have drastically affected how the entire system works, and as such has driven change, right, for the better or for worse. Then there are social drivers of change, market drivers of change, technological drivers of change, which is pretty much one of the most critical elements of change as far as the consumer side is concerned, and even sustainability. Therefore, the impact of factors such as those given below can be considered. And as change happens in globalization, in terms of geopolitics itself, you know that almost every day today, if you take almost every day, on any given day, at least 20 or 25 countries in the world are seeing massive protests around the globe, right? Even today, you can just go to Reuters and check. There are always massive geopolitics associated changes that are being pushed. Like for example, the recent situations in Spain, France, even in the United States are good examples of how the geopolitical dynamics are being affected. Even some of the things that we noted, if you look at the World War II and in fact the aftermath of World War II, of how Japan, after being, or after trying so hard as an empire, right, after fighting against the Allied itself, how today Japan has become such a big friend of the West, how Toyota has just dominated the market in terms of the automobile segment. And today we live in a world where Japan is deemed to be a good friend, a close friend to pretty much every neighbor, including the Europe and the West. This is geopolitics, and how commerce can be used to enable good geopolitics relation, as opposed to also what we currently see in today's world, how it can be used for negative things as well. Then obviously demography in terms of customers as well, but also from a company's perspective, every company has its own mix of demography, the element of customer empowerment, and digital disruptions through technologies like big data, automation, blockchain. All of these have to be considered and are elements that are impacted or affected due to drivers of change. And that brings me to this concept of resource audit. What exactly happens under a resource audit is simple. Now, even if you were to undertake a simple action or activity, let's say you want to build a house, you want to try and improve, or you want to get your team to do something that is completely new, you want to undertake a new project. Every single thing usually begins with an internal analysis, and in that internal analysis, we do a resource audit. Sometimes deliberately, sometimes knowingly, sometimes unknowingly. Now, as the word suggests, what happens here is we are trying to figure out what resources and what capabilities we have. So under a resources audit, what happens is you look at your competencies, you try and identify your competencies in separate activities and through linking activities that we associate ourselves as a business. Among them, we try and extract those core competencies, those things only we can do, those things that ideally lead to the unique selling propositions. Those are the ones that will allow us to outperform the competition and also open up new opportunities. Now, obviously, when you do your pre-scene analysis, this is one element that you have to be carefully thinking about, is to extract what the core competencies of whatever the company that you are analyzing at any given time. And that brings me to the next idea of assessing balance in terms of your resources, competencies, and business unit, because you cannot afford to go into extremes in whichever way you see. You can't overdo anything, you can't overexert yourself, you can't overexert your people. You can't afford to utilize too much of resources to a position where you cannot continue to be a going concern. Now, for example, overtrading is a phenomena. If you don't maintain balance in terms of sales, especially in terms of credit sales, you keep giving to the customer without recovering the money, but there is a limit that you can do it. You continue to do that, you will ideally become an overtrading company that can significantly affect your balance sheet, where you have a large receivables balance, but you don't have enough cash even to fund your working capital. And ideally, even in the books, despite the accruals concept promoting that in the books your numbers are looking good, in the cash flow statement your numbers are looking very bad, which makes the entire business a highly risky venture and puts you in a dangerous situation. And therefore, with the assessment of balance and the understanding that you need to be balanced, you do your internal analysis itself using a SWOT analysis and deriving the critical success factors, which we will understand as we go forward, but also things that you already know. And all of this lead to understanding your strategic capability. So knowing what you can, knowing what you're capable of, right, knowing what you can commit to is very important before you get into something. That is what we do through a resources audit. That essentially is the first step of any internal analysis or position audit process. That brings me to the idea of mission, vision and stakeholders. So as you saw in the rational planning model, the first element that you would notice, you can go back and check, is the concept of mission and vision. So without a mission, without a vision, without an idea of what you want to do, it would probably be like walking in the dark, right? You don't know what you're doing, you don't know where you're going, and that is not a position where you can operate a company, right? Even if you wanted to be in that position, right, you can't stay for very long durations in that state. So mission, vision, goals, objectives, these are very important for a company. So a mission will ideally be a derivation of your vision. And what happens is that you have a long-term aspiration that you want to achieve something like this, and that translates into a fundamental purpose which links to your SMART: specific, measurable, achievable, relevant and time-bound objectives. That is the idea of vision and mission. We'll take a good close look at it as we go forward. Then we also have to understand the stakeholders, because the executors of the mission and the vision are the stakeholders. They are the ones who execute. So without the stakeholders, there is really no company. Without people, there is no company, and stakeholders are groups of people. Now, in terms of stakeholders, we have a very useful tool called the Mendelow's matrix, which we will again take a look at, that helps us analyze our stakeholders and ideally to use that to decide how do we respond to various stakeholders. So that is a very useful tool. And as we analyze stakeholders, we realize that there are stakeholders that derive power from various sources, like positional sources, resource-based sources, system-based sources. Expertise can give a lot of significant bargaining power and personal power as well. On the other end, when you're dealing with multiple stakeholders, you can have conflicts, you can have competing objectives, you can basically have sort of be in a position where you're being pulled in various directions, right? So when that happens, what exactly can you do? Now, these are the 4 aspects or 4 actions that are available: satisficing, sequential attention, side payments and exercise of power. So ideally what happens is, if you're satisficing, it means that you prioritize and you decide how much you can give to each of those strings, and you execute them in some form or order that is convenient to you. On the other hand, you give sequential attention, where you decide which sequence of attention is the best in that particular situation, and you provide your attention, or you allocate your resources in that manner Side payments is obviously where you don't give them what they want, but you try and tell them that you can give something else, because whatever they want has to be allocated for something else. So you can use that model. Or ideally, if you are in a position of power, this is when you hit a stalemate and the CEO interjects and says, no, this is what you're going to do, and go ahead, right? Exercise of power, which is sort of like an ultimate move. Other than this, there is always the political activity or corporate political activity aspect to things, where you look at non-market strategy and the corporate political activity. Why politics is being focused when it comes to this is because you cannot really disassociate yourself completely with the politics of a nation, with the politics of a country. This is why we have a serious understanding, or we try to have a serious understanding, that politics can be a key implication for a business when it's trying to do business in any sort of country or nation, especially in the modern world. I can say, for example, the reason that Google, even Larry or Zuckerberg, or many of these executives from Facebook, Twitter, Google, YouTube, all these executives are appearing in front of the Senate, shows that politics has a lot to do with how things work. And regulation itself is usually under the political regimen, and therefore if regulation is affecting business, it means politics, lobbying, how rules are enforced, all affect a business. And therefore, as far as managing stakeholders are concerned, a business has to be very vigilant about how it manages the political activity the business is associated to. On that note, let's take a look at an example of a mission, vision and a goal, so that things are very clear. Say, now this is the vision, mission and a goal of an entity, where their vision is that every person has the support necessary to thrive as a small business owner. Every person has the support necessary to thrive as a small business owner. Now, this is an aspiration, right? This is a state of being rather than an action itself. It's this ideal world where whoever came up with this business is thinking every person should have the support necessary to thrive as a small business owner. But that is a thought, that is an idea, that is a vision itself. How it can be translated is by looking at a mission statement, like, okay, to create a world where every person has the support for managing a enterprise. How we do that is by targeting to foster vibrant small business communities through mentoring and education. So now you're seeing actions coming in. Mentoring and education are actions that you can use in order to foster vibrant, in order to motivate people to manage their own enterprises. And as such, this further gets translated into a goal. So this vision now got translated to a mission, and that ideally becomes a goal, which is quite specific, where they say help 1 million clients by 2020. There you go. You have a goal with you. And goals can be further elaborated through objectives. And objectives are supposed to be SMART, as in specific, measurable, attainable, relevant and time bound, right? Or some even say the R is discussed or proposed in multiple ways. Some say relevant, some say realistic. Either way, you can translate your goals into very specific and measurable objectives as you go forward, and it is important. It is definitely important. Now, say for example, the method that I use to coach for the students for the or learning partners to the strategic case study is by looking at not directly moving into a mock exam, but thinking about the 4 steps, right? We cover the revision by this date. So now we have an objective, and that objective is what you're currently engaged in, knowing the content, knowing the E3, P3, F3 content. So that is one objective that we have to complete in our overall mission of being a Cima graduate or being a chartered management accountant. I hope we are well on our way there. Let's continue. Now, how do you analyze stakeholders within an ecosystem? When it comes to the mission and the vision, they are the foundation ideologies behind an organization that affects all dealings with stakeholders. Many factors need to be considered when decisions are being taken within a business because it affects stakeholders in that system. So it's this idea that whatever you do, it can affect one person or the other, and therefore stakeholders are affected. Now, critical and fundamental factors that have to be considered are ethics and governance itself. Right? Ethics, obviously, when you deal with anything in life, governance from a more corporate aspect. Now, stakeholders can be classified broadly as internal or external, or even connected versus disconnected, and even non-market stakeholders that belong to the non-market environment. So there are these various classifications, right? You can look at stakeholders in multiple lenses, multiple perspectives. These are some examples. Fundamentally, the Mendelow's matrix can help classify stakeholders based on power and interest levels. Stakeholder alliances can be created by matching the needs of different stakeholder groups, and this is how this idea of the supply chain has become popularized, ideally where alliances of stakeholder groups have been created and linked through one lengthy chain. And in addition to all this, the association to corporate political activity is key in managing powerful stakeholders that can influence the organization's existence and stability from a political perspective, right? So you know, for example, there is the global corruption index, and depending on how corrupted a country is, we usually see a direct proportionate nature to how the amount of influence that politics can affect a business's operations, right? So it is a critical element, and if you're running a business, you have to be shrewd and you have to be smart. You have to be able to manage all of these, because we are just living in the real world. If things were ideal, no, right? Which is why actions such as lobbying, messaging, influencing public opinion, and even donations, etc., can be used, right? So how do you analyze stakeholders? This is the Mendelow's matrix, where you analyze stakeholders based on the levels of interest and the level of power. So in the Mendelow's matrix, you basically have high power, high interest, high power, low interest, low power, high interest, and low power, low interest. If you are a low interest, low power stakeholder, we say minimal effort is required, no need to engage or participate. Whereas if you are a low interest, high power stakeholder, high power but low interest, then needs to be kept satisfied, right? So you have to engage them, you have to be very careful, you need to keep them satisfied. So you have to, it means you have to maintain a connectivity. If you ignore them, and if they feel that they are ignored, they are not taken care of, if they are not satisfied, they might move from a low interest position to a high interest position, and that can be unnecessary and troublesome. Like for example, the tax department, right, inland revenue department, they might maintain a low interest level, but they have very high power. Now if you keep them satisfied by paying your dues on time and taking care of everything that needs to be taken care of legally, then they might remain satisfied. But if you start ignoring them, if you don't pay your bills, if you don't take care of your tax liabilities, then slowly their interest level will switch from low to high. That can be really painful. If you are a high interest, low power stakeholder, then ideally the requirement is to keep informed, right? You keep informed those stakeholders who have high interest but low power, because you know they just need to be informed. They don't need to be heavily engaged because they have low levels of power. But say for example, if you are in the let's say automobile sector, an automobile analyst might be someone with low power but high interest. So you and they can actually be useful tools for you to disseminate useful information to the market. So you keep them informed in a way that they are not blind and they trust you, and that faith is carried forward in different ways as time passes by. Ultimately, if you are a high interest and high power stakeholder, you are said to be a key player, and active participation is required, where the power levels are also high and interest levels are also high. And ideally, especially in the Cima strategic case study, what will happen is that you will most likely be appointed as the senior finance manager or senior manager in the finance function, and that directly puts you in this position, in this matrix, where you're a key player. You might have significant level of power in the idea that the director's ear, you have the director's ear, so you can say things that are recommendations, that are advisory to them. And on the other end, you definitely have high levels of interest, figuratively speaking as senior finance manager, but literally speaking because it's your case study exam and you're supposed to pass. Right? And this is the Mendelow's matrix. And on that note, I am going to conclude the first part of the first segment, where we are looking at ecosystem, strategy and networks. We looked at strategy and ecosystem itself. We have a very thorough understanding of how strategy formulation process is done and how important the ecosystem is. Why I decided to break the segment into two parts is because networks, there's plenty of important information to be discussed there, and I decided that having that as a separate component of segment number 1 would be very ideal and very helpful to you, right, in the ease of absorbing content. So on that note, I will probably see you soon on a different segment or a live session. Thank you.